We are live. This morning we were sitting on a 54% gain on Boyle, and we're not selling yet. Talk about why. This morning we had a 6% total return in 2022 for our high risk strategy, which is phenomenal. There's probably very few people who are up this year at all with all the volatility. 233% return in 2021. Are you ready to triple your money this year? This is the current Trade Alert recommendation for new trials. This puts $10,000 to work, and it's just to give you a taste for our overall product. Now we have two portfolios. We have the safe growth, where I like to store 70% of your money, and then the high risk for 30%. And in general, the concept is when the high risk is screaming up in value, take profits once a month and reallocate it to the safer strategy. And when we have drawdowns in the high risk strategy, pull some money out of your safer system and put it to work. Now, funny, our safe strategy is actually down to start the year while the high risk is up. And that's because we have a massive bet on natural gas, which has been going straight up. We got a cold front hitting the east. We've got tensions between Russia and Ukraine. We've got threats to cut off natural gas to NATO, and this is all stuff we saw quite a while ago, and so finally it's playing off. So let's take a look at the current asset allocation for a high-risk growth portfolio. On the top, you have your defense. That's typically something that goes up if stocks are going down. Right now, we only like one defensive product, UVXY. That's the VIX. That goes up if the SPY ETF SPY goes down. Not just goes down, it has to accelerate down. It has to fall at a faster and faster pace. So it really does well when there's a black swan panic event. We have a huge allocation to this, currently at 16% of the portfolio. I do anticipate we will reduce that next week. But boy, these markets have been just absolutely, excuse my language, but they've been batshit crazy, haven't they? Up and down and up and down. So we're just holding on to it a little bit longer. Talk about what the Fed had to say Wednesday, which was bipolar at best. FOMC minutes were completely different than the speech. And then we'll take a look at what's priced into the bond market for rate hikes this year, and then what we think is going to actually happen. So that's our defensive play. We could also have the dollar and treasuries in there when the time's right, but I don't think the time is right at all for those assets. That's why we're aggressively long on the offensive side. These typically relate to an inflationary market that's fueled by government increasing debt, and specifically government increasing debt while suppressing interest rates on their bonds so that they can borrow a lot more than they naturally could. So right now, because Boyle is up 50%, we now have an even relationship of the growth asset, which is your ETHE Ethereum, with 40% allocation, and then the 42% position in Boyle. Now that's spot natural gas prices. It's a bit different than our old inflationary hedge, which was NRGU, where we're playing the top 10 oil and gas companies. Both are designed to protect us against inflation. We took massive profits on NRGU and then rotated into Boyle, and now that's playing off. Boyle could go much higher, so we're not selling yet, but that is getting a little bit ridiculous on the ratio. So if we look at the strategy right now today, if you're getting started with a $10,000 investment, you would be buying 87 shares of UVXY, 217 shares of our favorite growth asset, ETHE. Now Bitcoin went from being something that's meaningless to now the Biden administration says they're going to put out some sort of report that crypto is a national security threat, which I look at as relatively bullish. We'll examine that more most likely next week, as there's 30-day commenting with a new framework they just put out yesterday, which seems to be looking at the DeFi space. So that's our favorite growth asset. Today, Ethereum is at 2490. I believe we will see Ethereum hit 12,000 in less than 5 years, and perhaps in a lot less time than that. Hopefully we can see it double or triple this year, and it's going to be our primary bet for the high risk strategy. BOIL will sell most likely, unless it just goes parabolic and outrageously up in the coming weeks on the Russia-Ukraine conflict. Most likely towards the end of February will be peak natural gas prices and the time to dump that, and then perhaps look at the next inflation hedge. So that's the overall strategy. We'll cover this in a lot more detail soon. But right now, that gets your money to work. Let's talk about the key macros to focus on in 2022. Well, right now, energy is priced sky high on oil and natural gas, and it could go higher. This is being driven by this Russian-Ukraine conflict. All sorts of crazy calls and intercepts going through that a invasion is imminent as soon as the ground freezes over. So anyways, paying close attention to it. I wanted to go long BOIL, even if that conflict was not occurring, to be clear. So we're not betting on a war for that position to play an important part for our portfolio, but it is helping us right now. Here's the bigger picture and what's much more important, and why we don't want to get too greedy on these energy plays. I'm actually expecting the value sector or energy prices to fall, and for interest rates to fall, for the global economy to slow down, and for tech companies to shoot higher on this news, because it will signal that we're going to need more fiscal support very soon, and that the inflation is going to be falling. So that's the big picture. I believe inflation will peak in March and fall into April. And so that is going to be incredibly important for how we position our portfolio, and why we soon should sell BOIL and double down on ETHE. Again, that's Ethereum. Now, here's what's really important. Congress increased the debt ceiling by $2.5 trillion, and now they just need to agree on how to spend it. Joe Manchin won't let him pass nothing until that inflation comes down and supply chains start to work themselves out. And that's happening, actually. We've got massive inventory builds. We've got falling consumer sales. We've got falling confidence, falling housing sales. We have rising interest rates across the board. And so I do think we're about to see the inflation begin to fall and pass the Build Back Better. Like it or not, that will be most likely passed, I'm estimating, in April as inflation cools off. So just big picture, I'm expecting growth to go up until Build Back Better is passed. And then once the Build Back Better is passed, that's going to put a lot of inflationary expectations back into the market. And most likely when we will be getting heavier back into energy once again. So we look at the big picture, cash is trash because governments globally are spending more money than they make, okay? And at the end of the day, that means they're devaluing their currency. And bonds are still not an attractive investment, even though I think bond yields are going to fall until the Build Back Better bill is passed. It's trading way below the inflation rate. Okay, the 30-year Treasury needs to hit 2.5% to 3% range. And the CPI, which is at 7, needs to meet it at the middle. And that's exactly what I anticipate is going to occur over the course of the next 12 to 24 months. We're going to see interest rates slowly but surely rise, and the inflation slowly but surely fall, and probably to that 3% range and meet right there in the middle. So investors really have no other logical option. People can freak out, sell stuff, go to cash, see the volatility hit the markets, but then what are they going to do? Stay in cash? Probably not. You really just have a few choices that make sense in this environment, and it remains stocks, cryptocurrencies, and commodities. We're going to be balancing the right mix until the bond market becomes too attractive. And we love to play treasuries. That's a very, very unique product. So we'll keep a close eye on that. But if we get a gridlock government after midterms and we get those interest rates up to 2.5 to 3, boy, oh boy, those could become a hell of a play for us. So what is our worst fear with the way we're positioned? Well, if we're heavy on growth, we're going to be very frightful of a strong labor market, which would drive interest rates higher. Good news is we don't have a strong labor market. The other thing is, have we miscalculated the duration of the inflation? It keeps going up. It keeps going up. Now, the last big stimulus was almost a year ago, last February, $2 trillion plus $1 trillion in December the year before, one with Trump, one with Biden. And the inflation's just not slowing down. What we have coming in for inflationary pressures now are energy costs, rent costs catching up to housing costs, and then wage pressure. Okay, so our expectations of the producer price index and consumer price index, I'm not saying they're going to fall to March. I'm saying they're going to slow down the rate of change to March. And then I do think we will fall into April. Now, remember, March had basically negative everything. Oil went negative. The whole world shut down 2 years ago. So the year over year print on March is probably peak inflation. And April it falls. If so, it's going to be exactly what Congress needs to go do what they do best, spend a bunch of money they don't have. So it's critical that you watch our webinar every Monday, Wednesday, Friday to be ready for the trade alerts. Now, if I'm wrong about our positioning and anything goes haywire, our insurance policy, our safety net is UVXY. This protects you against significant stock crashes. Okay, it's not going to make us a bunch of money if the market's slowly going down, but that's not really the way this market works when it's so leveraged. It's flying up and down, and UVXY has actually also appreciated about 50% since we recently added to it. So last time we had a big crash, you can see it went up 1,100%. So a 10% position completely protected you. Even if the other 90% had gone to zero, you'd be sitting on a 10% return at the peak panic moment. And so, again, I don't see a big crash in the works right now. So we'll cover that in more detail, but we're extremely protected right now at over 10% in both strategies. Now, if you don't want to miss out on the next trade alert, call John if you're on a free trial to upgrade at 505-610-1334. Okay, let's take a look at some data. I'll see what chats we have coming in. Okay, Bill G says, what about the price of ETHE? How does it compare to the big Ethereum? Yeah, on the way up, ETHE will outperform Ethereum. On the way down, it will underperform, has been the trend. So you could actually probably outperform the real Ethereum right now by about 24%. We'll look at that data in a minute. Now, for much of its history, it's actually traded at a premium. So perhaps you can now, anyways, bottom line, they're highly, highly correlated, and you're very well off just owning ETHE. You don't need to necessarily go buy the real Ethereum. Let's see. Eddie says, hello, Jason. Since now the Feds are tightening in the next months as a macro cycle, do you think we are on the downtrend if interest rates are going to rise higher? Also, no further money from the Feds. Does that mean we're hoping for Biden to leg up the market? Yeah, so I think the hawkish talk will reverse and the interest rate hikes will slow down. So yeah, my expectation is interest rates fall to April, growth outperforms, Build Back Better's passed, and then energy outperforms after that. That's just big picture without any shocks or surprises, what I'm anticipating. Willie says, is melt up bullish? Yeah, melt up is absolutely means we think the price is going up. Okay, so reverse repo is essentially a buffer for quantitative easing. It's sitting at $1.6 trillion. We're not going to believe the bond market's on the verge of collapse until this is drawing down below $1 trillion, probably closer to 700 billion. It is stubborn, sitting at 1.6 trillion. That means don't freak out and sell your growth assets. There's still a lot of QE backed up into reverse repo. All right, in this chart, we are looking at BOIL and NRGU. And we made the right call, just kicking NRGU's butt and up a lot. So very similar play. We do both of those for the same reason, but oil was near a high while BOIL was way below recent highs. So we went for the value play and got a little bit of geopolitical tensions to help it out here. But yeah, I think it can go way, way, way higher. If we zoom out a bit, let's just see some of those recent spikes in BOIL. So there's where BOIL just went screaming higher. So yeah, we saw this opportunity, and it sure is playing out. I think we were getting in somewhere in this area. But yeah, again, all the right elements are coming together at once for BOIL to have an outrageous return. So we're excited and don't intend to sell that right away. All right, in this chart, we're now examining NRGUs. That's your top 10 oil and gas companies times 3. We've got the yellow line, interest rates, and then we have the NASDAQ in candlestick. And the NASDAQ and Bitcoin are essentially extremely correlated. I look at crypto as a technology tech asset at this point. And so what I want you to note is that when the yellow line goes up, your growth, tech goes down, and your energy goes up. And that's our whole strategy in a nutshell right there. So we've had interest rates have some volatility to start off the last 30 days, really. You can see that yellow line going up about 15%. And tech stocks did not like it, and energy did. Okay, so what do we think's happening next? Are interest rates going to keep going up? Well, Atlanta GDP just came in at 0% after being at 8%. Retail sales are falling, housing sales are falling, fiscal support is weaning, QE is coming into an end. They're talking about rate hikes. Okay, so I highly believe that growth is going to slow and interest rates are going to fall. Which means, it's funny, growth's going to slow, so we want to go long the companies that do generate growth. So that remains our expectation. And I think that energy costs will fall as soon as the conflict in Russia subsides. Until then, it may stay quite elevated. Okay, there's some sort of breakup of Evergrande yesterday caused another sell-off in China. So we're looking at emerging markets in this chart. Below, we have FXI and MCHI. So emerging markets is a lot of Asia. Typically 1/3 of that is in China. FXI and MCHI are completely Chinese ETFs. So they had a huge problem with a lot of real estate companies going bust over the last year, arguably busted up on purpose. And so they are restructuring Evergrande. That did create another sell-off. Remain bullish on China and Asia for this cycle, which I expect to be at least 5 years in length. So keeping a close eye on it. EEM went below 48, which is a level I believe is dramatically oversold. It's at 47.11. We'll keep a close eye on that at this point, not worried about it. Now, this chart is your most bearish chart. If you wanted to predict stock crashes incoming, this one doesn't look good whatsoever. This is the Russell 2000, Stanley Druckenmiller's favorite leading indicator of stocks. And what's really disturbing is this one tends to follow rates higher. And so we can see interest rates in yellow rising. Russell 2000 did great. Then rates fell, and the Russell 2000 traded sideways, which I thought was very bullish. And then when the interest rates spiked this time, and perhaps it's because it spiked for the wrong reasons, because the Fed's behind the curve, it created systemic selling across the board in all assets. And boy, the Russell 2000 got really beat up. I would have expected it to go up with interest rates rising right here. So we're going to keep a close eye on that Russell 2000. We don't have any direct exposure to it. We do need to be honest with ourselves. Some of the bigger companies in the Russell 2000 are complete junk. GameStop, AMC. So we'll keep a close eye on it for the time being with the Russell 2000. Similar to the Russell 2000 in its trading pattern is the European index. So EFO, we're using a leverage product on that again for safe growth. We're also in emerging markets with safe growth. And very similar setup, not as big of a sell-off, but once again, typically with rates rising, we would expect a big bid here, and it didn't happen. So keeping a close eye on that for now. Let's see, someone's asking Boyle from UNG. I don't know the specific difference in that one, Michael. Probably pretty related. When are we going to get back into NRG? What price target? Well, let me get to we'll probably target it based on a pretty significant sell-off in oil, which probably won't happen until the Russia-Ukraine conflict calms down. Now, NRGU is the top 10 oil and gas companies. USO is spot oil. So Boyle and USO are quite similar to one another in terms of playing the spot price. NRGU is actually playing the top 10 US oil and gas companies times 3. Okay, wow, dollar index jumped a lot today at 97. So for Ethereum to go up, guess what? We want the dollar to be falling. A good signal for when to make some significant changes will be when the dollar falls towards 90. I think that's going to be a major rebalancing and quite likely a good time to go long treasuries and the dollar. But for now, I like our current positioning, expecting that this will most likely fall. But that is quite a jump, most likely relative to all these tensions building over in Europe. Okay, next chart is the Turkish lira. This was causing a big bid on the dollar. Excuse me if I mispronounce his name, Erdogan basically guaranteed Forex losses to its citizens after the currency devalued by over 50%. And that has stabilized the currency, which was definitely causing a big demand for dollar, and I believe also causing selling in cryptocurrencies. So we've been keeping a close eye on that. Looks like that issue is so far resolved. A little bit of a dump. Oh, this might be why we're getting the bid on the dollar today. The Chinese yuan, we've been following to see if they were going to devalue their currency to bail out the real estate market, and if there's contagion from that. And the reality is the only currency that's outperformed the dollar in the last 12 months is the Chinese currency. So China looks very, very strong, even though their stock market sure doesn't look like that. Okay, now in this chart, I ignored this signal last summer. I was very convinced that the cost of energy was going to go up as we get the world economy online. I was a little bit early. We had a big spike in our oil, And then it came back down, and we missed out on a profit-taking opportunity. And the signal to take profits on oil around July was warned way back in May by lumber futures falling. Okay, then lumber futures began to rise, oil kept going up, and natural gas had a big sell-off. And that's what really gave me the confidence to put such a big bet on such a risky asset, which is oil or natural gas. That's a very, very, very difficult market that takes a lot of stomach to play it. And boy, is it playing the right way for us currently. Now we have some signals that inflation could be coming down. Now, again, that signal last time was about 2 months in advance notice. So the decline in lumber futures just starting. We've got slump in housing sales, we've got very low inventory, and we've got interest rates rising. So it makes sense that lumber is starting to slow down here. We've got inventories building. So yeah, I think we really need the conflict from Russia, Ukraine to resolve, and that we should see a pullback in some of these energy costs. So that's what we're expecting currently in energy, while it continues to surprise to the upside, doesn't it? Here's a look at some of these tech giants. Go to a little bit. So these guys, which is what most of the world's overweight in, sure have been having a bad stretch. Let's see where we can hit peak drawdown. So if we go back to December 22nd, let's see, let's go to where interest rates began to rise. So the interest rates really started to rise December 6th. And so we can see NVIDIA selling at a 24% discount, Tesla, Amazon 16 and 14, Apple just kicking butt. I think they just had the most profits of all time and profit margins, and they've fixed their supply chains and this and that. Up 6%, while the other tech giants are all down. Microsoft hanging in there, Google hanging in there. Now let's look at a shorter time frame. And so starting to see some good bids on there. But again, I do think those energy costs need to come down, and we'll get those interest rates to really fall, because all the data is showing that without more fiscal stimulus, everything is dramatically slowing down. Now, these are some companies in the SPY index that are not tech, just to get a feel for it. And so to see if we're really seeing this growth to value rotation. So I'm going to go to a similar period. Where interest rates began to rise. And so the big spike in interest rates has caused problems for a lot of indexes due to systemic selling. But Berkshire Hathaway, the clear winner here, up 11% since interest rates began to rise. Okay, over in Asia, we are looking at 3 companies just to get a feel for investor sentiment, and the Taiwan Semiconductor trading very strong. Did not get phased by this sell-off. We've got Tencent and Alibaba, which were starting to get a big bid and then pulled right back. So I believe the outperformance from Asia is coming, but boy, we've been patient for that to occur. And there's been some little head fakes, at least since the interest rates began to rise. In general, this is starting to head the right direction. And quite likely emerging markets are down a bit due to that dollar strength today. Okay, from Europe, we are focusing on Toyota and ultra strong, no weakness there. So really the main concern we have in stock market charts would be the Russell 2000, certainly the most bearish signal we have yet. Okay, for NRGU, I don't like to look at technical analysis on it because it's a 3 times leverage product. What I do like to do is look at the Exxon, which is the largest company that's in that ETF or ETN. And so If we do look at all-time highs back in 2014, this hit 104. And we had some very high oil prices back then, which are quite likely coming back. I just believe that the energy is going to come down, Build Back Better will pass, and then we go to these $100 targets that everybody's throwing out there. With that said, oil keeps climbing, and we've almost touched 90 in the last 48 hours. So this is definitely surprisingly strong. And again, why we were hedged against this with oil. Okay, here's where we're starting to see a little divergence in the price of oil compared to interest rates in yellow. And I do think everything's been overdone on the inflation side, the rate hike side, the energy cost side. And so we're starting to get those bonds just to call BS on it. This is the long end of the bond market. So I think we need to be careful, get out of oil, and then get ready for growth to take off next is really what I'm expecting. But boy, oil and oil just keep going up. Okay, we got a little bit of a sell-off in copper futures. These are at very elevated prices. Let me zoom out on that a little bit. China by far is the big driver of copper prices. You can see it's traded flat since May, up and down with volatility ranging about 18%. But that's been really coiling up. And so we'll keep a close eye on it. It's not really giving us a clear signal. But overall, we're not seeing crashing copper prices at these elevated prices. Baltic Dry Index could be the warning that the inflation is going to subside. So while the cost to ship freight from China to US still at, I think, record levels, the cost of shipping commodities between continents has fallen a lot. I mean, a lot, from the 5,300 all the way down to 1,300. So that's similar to that massive crash we saw on lumber prices. So once again, I believe we need to time oil correctly and then bet on growth more aggressively with the proceeds. All right, let's look at this damn 2-year. Every time we think it's going to give us a break, it keeps going up. So the 2-year is what essentially controls the federal funds rate. So Jerome Powell's mostly going to be in charge of that 2-year with what he optimizes with the Fed. The long end is more Janet Yellen in terms of how she sells debt, refinances debt, and of course gets budgets through to give growth expectations. In general, we have a flattening of the yield curve. So that's not great news. It means without more fiscal support, we're going to hike rates to kill the inflation, and then growth is going to go dead. That's not a good sign, but it does let us realize, okay, if we look into the future, most likely this is telling us the growth is going to slow. These rate hike expectations are going to slow down. So I think we're as hawkish as we're going to see in the last month, and from here on out, that the policy is going to slowly but surely become more dovish, which is exactly how we're positioned. Now this is the 2-year minus the 10-year. If it goes negative, that predicts a stock crash, recession. And typically what happens is the yield curve inverts and then it steepens, and then you get the crash due to interest rates rising. So we're a long ways from going negative here, but it's certainly headed in the wrong direction. Which, to be clear, we want it to go up if we believe we have a healthy economy. Okay, here are 3 critical bond markets, and there's some damage happening here. Not a lot, but J&K, TLT, and LQD are all down. LQD primarily financing tech giants, and you can see it's down the most, and tech stocks are down the most. So we're certainly seeing pain in the markets due to the volatility in the bond market. Absolutely. So the question is, do we think the bond market is going to keep crashing as growth slows? No, absolutely not. All right, now in this chart, we're comparing Tesla to Ethereum. These are the only two assets that have really given each other a run for their money in the last year. And so depending on what time range, you can see either Tesla's greatly outperformed or Ethereum's greatly outperformed. From this time horizon, if we believe these are highly correlated, we really want Tesla to stop selling off, rebound, and we can believe that Ethereum will break to new highs. And that's absolutely what I am expecting in the coming months. Alternatively, if I'm wrong, energy keeps going up, rates keep rising, Tesla crashes and catches up to Ethereum. So we need to be patient and watch. Now this chart, we're comparing Bitcoin to gold. They now have an inverted correlation to a degree. It's hard to see that. So should we be betting the farm on gold while it's up? Let's see if I can get it to be priced up 4%, or should we be buying the dip on Bitcoin? Yeah, I believe we should be buying the dip on Bitcoin, GBTC, and that's in our safe growth strategy. All right, so you give me a 90 DXY, I'll load you up with 3 products. Well, we'll probably be taking profits on UVXY well before that, but EUO for the dollar, Treasuries TMF, and then UVXY will add to it at that time. So DXY to 90, we will get into the deflationary camp, betting that the dollar will have a bounce off of 90. Again, now it's at 97, so we want to bet that the dollar will weaken. Let's look at some pain and some of these other alternative places. We're not in carbon credits right now. It looks like it's almost certainly going to be, I believe we're going to see the Republicans take over the House and Senate in midterms at this point. So I don't think we should consider carbon credits. But the other energy products are certainly useful to consider. We're not in TAN, but boy, that one's been getting beat up, down 22%. Uranium down 16%. I do like that long term. My favorite long term alternative energy play is rare earth metals for batteries, for electric cars and iPhones. And we got COPEX doing flat right here. So interesting to see that these products are down while the dirty energy is up significantly. Now here's the gold to copper ratio. In general, I'm anticipating copper to outperform gold as we slowly but surely recover the economy and spend lots and lots of money that we don't have in the government. So I'm expecting a move similar to 2002 to 2006, which means interest rates should rise. And that cycle was about 4.5 years. Michael says estimated time frame ETHE. Well, you mean when or how long? I think it's going to rise very, very soon. And then once the Build Back Better bill's passed, if the bond market crashes, that it will pull back again. Is what I'm expecting. Okay, now here we go. This is updated. This is the futures market predicting the interest rate hikes come March. So it's almost certain on March they will raise interest rates 25 basis points. A hawkish surprise would be a 50 basis point jump. That probability was trading in the 3 to 5% range, and today it's jumped to 8.5. And that 2-year just keeps going up. It's now pricing in 5 rate hikes for this year. But again, I believe that data is all going to start to turn down due to a slowing economy. Here's a look at our yield curve, month over month over month. and it just keeps shaping worse and worse and worse. So on the front end, we can see the 1 and 2 years keep jumping up while the long end is curving down. Okay, it's the exact opposite of what we want. I'll show you what the shape that the banks and the government really would like it to look. Okay, right here. This is much more what they want to shape the yield curve. So it's just not happening right now. So now here's the VIX futures term structure. This is the perfect shape to make a ton of money in the VIX. That's why the VIX is expensive right now, because it's also in the shape to lose a lot of value quickly. Okay, so in general, right now, this is perfectly positioned. If stocks dramatically drop from here, UVXY can go up extremely fast. Okay, and in general, what we want is the front end to be above the future dates, and that's what makes that product go screaming higher. So any more pain, UVXY is going to deliver in spades. So soon as we're a little more confident the bond market's done getting so grumpy, we're going to go ahead and reduce that. I don't believe we're about to get a big stock crash and get rich from UVXY right now. So for now, we're just being patient because the Fed told us two things. FOMC minutes were very dovish, that they will be data independent and nothing's going to happen until March. And then they had a press conference where they asked him, well, could you maybe hike by 50 basis points? It says maybe. Could you hike at every meeting? Yep. They asked him a whole bunch of hawkish questions and gave hawkish responses to all of them. But again, I think we're at peak hawkishness due to clear data. Everything is slowing down. So we got to watch that CPI, PPI to make sure that I'm correct on that front. Okay, lots of volatility in the crypto space. Everything's down. Bitcoin's down the least. Here's that PPI data. So it had been slowing down for much of the year and then jumped in November, December. So this is critical. This leads to CPI, obviously, and I expect it should be slowing down before the CPI. So we'll keep a close eye on that data. Here's the non-farm payroll. So the labor market was very weak. So do you look at this as a tight labor market or a weak labor market? Either way, we're 3 to 4 million short jobs pre-lockdown era. So what impact will that have on the economy? Obviously not a good one. Less people generating income and productivity for the country. All right, here's our CPI. This jumped 0.3 from October to November. Then it increased, it accelerated from 4.9 to 5.5. So the rate of change doubled month over month. This needs to deaccelerate by February and fall by, by March and fall into April. If that does not happen, I think we're going to see volatility in bonds and stocks. And it's going to get nasty. So we'll keep a very, very close eye on that data and see what that January print's going to come in at. Okay, jobless claims are on the rise again. That's not a good sign for growth. Here's that labor force participation rate. Let's see, it's gone from 61.5 to 61.9. So slow recovery here after the V shape. So now it's the square root sign. So very, very slow but steady recovery. And that's actually what I believe is most likely to occur. Okay, banks are expanding credit. So that's very good if we're long stocks while fiscal policy is slowing down and QE is coming to an end. Consumers are borrowing a lot, just hit a record borrowing on consumer credit, $39.99 billion last month. Retail sales fell 1.9. We'll see what the next few prints come in. We have had, last time we had negative print, February 2.9, they sent out stimulus checks and you got a big jump for 1 month and then it stayed strong for a whole year. So shouldn't over-examine one bad month, but you get 2 or 3 of those coming in, and we'll see how that plays out. China's PMI is starting to rebound after going negative. They've been trying to clean up their economy so they can have a freely trading currency and open bond market and more prosperity evenly spread out across its people is in general what it's trying to do. Chinese imports hit a record 2 months ago. Last month was still second best month in terms of import demand. This is while they were tightening. So imagine what their demand for imports will be if they start to aggressively expand credit, which is what's anticipated this year. Exports $3.4 trillion. So no slowdown in demand. We are starting to see inventory levels build though. So perhaps this could slow down as the global economy slows down. Okay, Fed's balance sheet sitting at $8.86 trillion and won't stop going up till March. And the ECB keeps on printing away. So those are perhaps the two most important short-term data points. Bonds are still being suppressed and money is still being printed. Zero Hedge says recession secured. Bank of America joins JP Morgan in slashing Q1 GDP growth. Now sees just 1% in Q1. Says there's risk of a negative growth quarter. Okay, so if growth slows, bond yields fall. If growth is expanding, then interest rates rise. So that's why we were overweight in growth, and then Boyle just went screaming up on us. Here's a look at that inventory build. So this should help suppress inflationary pressures here. Markets still can't believe GDP can go from 6.9 to less than 0% in one quarter. Savon Henrik says Kashkari, a Fed dude, already trying to backpedal on increased rate hike expectations. Financial conditions have already tightened by letting asset prices drop. With jawboning, the economy is slowing fast, and that will limit any rate hikes later in the year. I repeat, this is all a performance art. So he doesn't believe the Fed will actually fight inflation, even though they're talking a strong game. Natural gas soars as 45 million Americans face winter storm threat. Plus, again, we got Russia threatening to cut off Europe from natural gas if they get kicked out of the SWIFT dollar banking system. Now, another way to play oil is to go long Russian stocks or its currency, which have dramatically become uncorrelated to oil. So that could be a fun way to get that exposure, but I don't dare mess with that right at this moment. So we get a better idea of what's happening with this Ukraine, Russia. Okay, mail-in voting found unconstitutional. Okay, now this just further makes me believe with the polling data that we will have a split government. At least one of the branches will switch Republican. So that could slow down spending post midterms. So we'll keep a close eye on that as we get closer. For now, not a huge impact. Okay, the long view says looking for a rotation. Data is moderating a bit, mostly OMICRON though. Can't say that out loud without risk of censorship, which should temper worries over the Fed for now. Oil is also too rich due to Russian intervention. Both will help with rates. It means when they fall, that should also bleed into growth versus value, long 2-year and short value versus growth. Interesting protests with the truckers in Canada. I did like this. 2010, this is talking about Bitcoin. 2010, no one uses it. 2011, only cypherpunks use it. 2013, only criminals use it. 2015, only nerds use it. 17, speculators use it. 2019, small firms use it. 2021, small countries use it. 2022, breaking headline yesterday. Biden says this is a U.S. national security threat. For heaven's sakes, of all the problems he has. He's worried about Bitcoin. The long view, Bitcoin has ironically been leading the whole sell-off due to its dual utility as a tool of extreme speculation and a perceived hedge against excessive easy monetary policy. And it appears, at least temporarily, to have found a bottom. Subtle sign of risk-taking emerging. And he says once the buy the dippers get in it, things can go up quickly. And that sure is true. A lot of the gains in crypto happen all at once. And you have to be willing to sit there in the drawdown to catch the big upswings. The casino is not designed for you to just win 24/7. Mr. Whale's a big Bitcoin bearer right now. Character, I don't know too much about him. MicroStrategy, he's renamed Micro Tragedy, is now down 75%. Jim Bianco says, so the Biden administration is passing along inside information to Wall Street. So luckily we were long that asset that benefited from this supposed insider information. Wall Street briefed by Biden team on possible Russia sanctions. Now again, Russia's response is if you kick us out of the SWIFT dollar system, we're going to cut off natural gas to Europe right during winter. So no wonder they're making all this moves right now. Okay, Apple's sales hit $120 billion record high, showing that it has tamed the supply crisis. Rudy Heavenstein, I'll skip that. Nomura Bank forecasts 50 basis point Fed hike in March. So we'll see. Right now, the futures market has that priced at 8%. It's a long ways away. Let's see how this data comes in. Here is the average revenue per user at Robinhood. You can see it's falling ever since the stimulus has ended. This is the main reason why I think inflation is going to slow down, is that the stimulus is wearing off. And so while there's still a ton of money in the system, the rate of change of increasing the money supply is slowing rapidly. So at some point, the inflation should dramatically slow down. Okay, so here we have Rick Ryder. Yesterday, we heard from the Federal Reserve's Federal Open Market Committee and from Chair Powell at the press conference on the evolution of monetary policy and the too long awaited end of its quantitative easing program. While this was well anticipated before the meeting, we can now safely wave goodbye to a QE program that overstayed its welcome in our view. We also think we have officially begun a two-stage process of gradual departure from emergency monetary policy conditions. The first stage being a return to a more neutral, normal monetary policy, which they estimate will be 1.5% to 2%. And secondly, a potentially more restrictive policy to address what has clearly been surprisingly high and sticky levels of inflation. And that's where they could start doing quantitative tightening and target certain parts of the treasury curve to get that the right shape. First, getting to neutral. We think that over the next 18 months, the Fed will bring rates just below the level of potential growth, 1.5% to 2%, and will allow for the runoff of the extremely large excess reserves, which is the reverse repo that we just looked at $1.6 trillion sitting in the banking system. We think that we are starting to see bank lending and general velocity conditions improving in the economy after years of M2 liquidity growth, printing money that at the beginning of this recent stage of QE was very much needed. The Fed should continue to promote this transition, but we will learn over the coming months how it will attempt to balance this reduction alongside the currently high levels of inflation. Likewise, draining liquidity much beyond the 1.5 trillion of reserves built up over the past year in reverse repo or so could tangibly impact financing markets and consequently could impact velocity improvements and slow the economy. So he's worried that interest rates could rise as that falls, which is exactly what I'm telling you is the best signal to predict that rates will rise. That has to fall. What we've heard from the Fed or from Chair Powell makes it clear that 3 to 4 policy rate hikes this year is within a reasonable estimate for Fed execution, along with the end of QE and some later, potentially summer, deliberate runoff of this excess liquidity. So they're just talking about letting the bonds expire without reinvesting them. That'll make the balance sheet slowly shrink, but without controlling exactly what parts of the curve are being affected by that. It is clear at this point that the Fed has inflation firmly in its sights, despite the still maturing nature of this economic recovery. But it has also very much kept the door open to adjust policy if the economy slows from here. And that's what I really got out of the FOMC and speech. If the inflation keeps up at this rate, they're going to hike and crash everything, essentially. If it slows down, we're going to have a dovish pivot, and it's going to be highly beneficial to the growth sector, the tech companies, crypto. Goldman sees a very benign inflationary picture by the end of the year, expecting this to slow towards 3.5. Actually, they have it going to 2.5. I doubt that. We'll see. Elon Musk been going at it on Twitter, saying he supports the Canadian truckers. Biden is a damp sock puppet in human form. Elon Musk tells 71 million to vote them out, stands with Canadian Freedom Convoy. If you scare people enough, they will demand removal of freedom. This is the path to tyranny. The Fed should consider outright sales of bonds to shrink its balance sheet rather than merely allowing its holdings to mature. Zoltan, a bond expert, was posting. And more importantly, they could sell bonds specifically to shape the yield curve the way they want it, in a partnership with Janet in terms of where she issues debt and refinances debt. Okay, so here's the new SEC rule. This essentially saying, we've already known about this. It doesn't state specifically Uniswap or DeFi or liquidity pooling or yield farming or anything of that nature. But in general, it could be used to believe that essentially, if you are on a DeFi exchange providing liquidity, that you'd have to know exactly everyone who's trading with you and be able to report that to the IRS. And that's not possible. That's just not possible. So we're going to see how this plays out. Keeping a close eye on this is obviously, as we are very aggressive in crypto. So big article by a lawyer posted on that. Okay, so here's your discount on Bitcoin and Ethereum. If you buy GBTC, you're buying Bitcoin at a 30% discount. Okay, if Bitcoin keeps going down, that discount will probably grow. You'll probably lose more on GBTC than you would with the real Bitcoin on the way down. On the way up, we've seen this discount window in the last 12 months as low as 5% negative. So you could outperform Bitcoin 25% with GBTC. You could probably outperform Ethereum with 22% with ETHE right now, assuming they do go back up. So yeah, I can't wait to add to those positions. Safe growth will add to GBTC, and high risk will add to ETHE. And most likely it'll come from reducing exposure to BOIL in both portfolios and reducing exposure to UVXY in both portfolios. Not ready to do that yet. The inflation, the energy costs keep surprising me to the upside, as does the rise of that 2-year bond yield. So I'd like to see that start to stop being so aggressively rising. Okay, very good. So let's go ahead and look at portfolios now. And if you're catching this on YouTube, you're going to miss out on the best part. You're not going to get the exact asset allocation and number of shares to buy per $1,000 invested. Call John now to upgrade at 505-610-1334.